So let's talk about some tax items that landlords need to keep in mind.
The first 5 years is 90% interest. But what people don't realize, 1 year later, now you can write off 75% interest. So you get it back on your taxes the following years. And your tenants are paying for your mortgage. So It's not like you're paying it, tenants are paying it, and you get the benefit the following year.
What about a non-self-employed example?
Yes. So the example we have is this W-2 Matt. He was very straightforward. So when you're non-self-employed, just W-2, it's really simple for the lenders. W-2 is easier from a lender point of view because it's like, just give us a pay stub or your W-2 or both, and then that's pretty straightforward.
So the point here is whether you're self-employed or you're W-2, make sure you understand the tax situation, and especially if you're self-employed, make sure you talk to a lender that also understands the self-employed game, because some lenders are great at it like Troy, and some lenders, it's not their area of specialty. What's up, house hackers? On today's episode, we're going to be talking about tax strategy and tax preparation. And this is really geared towards house hackers, whether you're looking to get your first property or you might be in your second, third, fourth property as you scale up. There's a lot of nuances to discuss, and a lot of things can help you get your next deal or potentially not help you qualify for your loan. So before we get into details, standard disclaimer here, we are not your CPA. We're talking about our personal strategies, what we know, and how it's worked to do deals. Make sure you go out there and talk to your CPA. And if you need a referral, let us know. But I'm joined by two experts here in the house hacking world. Jeff White, broker and house hacker extraordinaire. Good afternoon, Jeff, or good morning.
Good morning. Thank you.
And then Troy Howell with Nova Home Loans, lender extraordinaire and house hacking.
Thanks, Chris.
Good morning to you, Troy.
Good to be here with you.
And so what we're doing, this is a presentation that Katie, Jeff, and Troy presented a little bit ago at our monthly House Hackers meetup. And it was a topic that had some of the most interest we've seen in a long time, so I wanted to record a podcast out of it. And a big shout out and thank you to Troy, who is a sponsor of the meetup and also a sponsor of doing these podcasts. So thank you, Troy, for getting all the right people in the room. All right, Jeff, I mean, we know the importance as a house hacker yourself and as a broker, you know, when doing deals here, the importance of balancing taxes so you can get the loan, so you can buy the house. So where do we start when we start talking about this topic to clients?
Well, yeah, it's definitely W-2 versus self-employed, I guess, the first piece of it. And W-2 is pretty straightforward. You know, it's just like, what's your salary? And then lenders look at it very straightforwardly. It's like your gross salary. That's what they go off of because they know your employer will take taxes out. So they give you the gross number for your debt to income ratio. Self-employed, this is where it gets really creative. This is where, unfortunately, what people's goal to reduce their tax liability is compared to what the lender, what you want to qualify for, doesn't always meet in the same spot. And Troy knows this firsthand with the self-employed people.
Many times.
They write off too much and they say, I want to qualify for $1 million house. And then they show they make, $50,000 net. And the lenders love to use the net number on self-employed because that is post-tax. So that's the fine balancing act where if you want to qualify for a conventional loan, you have to go off what rules they have for self-employed people. And you have to be really careful. And the best way to do it, and I've learned this, is prep your tax return, just do a draft. Draft tax return, give it to the lender, ideally Troy.
Right.
And then they can review it saying, okay, you can tweak this, tweak that, bump up this. So you qualify. If you say, I want to qualify for a $500,000 house, they could point you in the right direction versus if you just file it and now you're like, okay, I got to amend my tax return, and that could take, months sometimes if they even delays your buying decision. By doing so, now you're at a point where I'll use myself as an example. So on my last year's tax return, it was my first year of being self-employed and not relying on W-2 income. So I had to...
Your 23 tax return.
2023, yeah. So I had to really focus on a strategy of finding that balance, what we talked about. So I don't have the W-2. So I had just self-employed and then the rental properties, of course, too. But how do I find that balance where I can write off the most amount possible and still qualify for something? And that's where that draft tax return sent it to Troy. And by using Troy, he actually found $12K savings I didn't know I had.
So, yeah, I don't know if I'd give myself so much credit, but I think it's, you gave me the draft,
Yep.
and it's like, Jeff, you're more than qualified.
Yeah.
Take advantage of all the deductions you have available to you
Oh,
from
yeah.
your CPA.
Yeah.
And so you went back to your CPA
Donovan.
and said, hey, let's do the full deductions
Yep.
that I'm capable of, which saved $12,000 in tax. Yet you still qualify just fine for what you were looking for.
Oh, yeah.
And that was kind of the key.
I almost went too conservative with the
You were being
other
concerned.
direction.
Yeah, you didn't want to sell yourself short. You didn't want to take too many deductions that you had available to you. So you kind of left some money on the table
Yep.
in order to make sure you didn't hurt yourself or handicap yourself from being able to buy. So we were able to analyze it, determine you were in good shape, and take those full deductions. You still qualify just fine.
Yep.
Yeah. So it worked out. Awesome.
No. And that's the whole point of this podcast here is educating people and then making sure, this is part of like building your real estate investing team. And especially as you're self-employed and you start getting to multiple properties, the tax piece becomes so important in addition to the broker, in addition to the lender. Your tax advisor, your CPA just becomes a critical component to help you figure, hey, where's the right balance and everything to make sure that we can optimize for your investing goals and optimize for your business goals as well.
Precisely.
So, what about a non-self-employed example?
Yes. So the example we have is this W-2 Matt that we had as a client. Don't want to name names, Matt, but he was very straightforward. So when you're non-self-employed, just W-2, it's really simple for the lenders,
Especially when it's his
easier to
first,
look at,
his first house hack too. So
Yeah.
he had no real estate to his name,
no debt,
no debt.
So
he
just-
was good on his debt load, and he was buying his first house. So very straightforward.
just his salary. What's his monthly salary, or I guess annual, and then you divide it by 12.
Correct.
And then how much debt they have, and that's a very simple ratio then for the lender. So there's no complications of he's writing off too much from his self-employed business. So W-2 is easier from a lender point of view because it's just give us a pay stub or your W-2 or both, and then that's pretty straightforward. I'm sure you still ask for tax returns, of course, too, but
well,
easier to
in his
qualify,
case,
yeah.
we didn't have to because he didn't have any Schedule E to deal with too.
Oh,
So we have W-2 clients that we work with that come back and do their second and third house hack.
Yeah.
Now I've got to look at the tax return because I've got to look at the Schedule E to see what that property's been doing.
Okay.
Yeah.
So the first one,
First
no
one's
tax return.
first one's easier, but to Chris's point that you made earlier is that you got to kind of strategize to make sure you don't pickle yourself with your first house hack, so you can't do subsequent house hacks.
So the point here is whether you're self-employed or you're W-2, make sure you understand the tax situation, and especially if you're self-employed, make sure you talk to a lender that also understands the self-employed game, because some lenders are great at it, like Troy, and some lenders it's not their area of specialty.
Yep, and within the context of being a house hacker, for sure.
Correct.
Yeah.
So run us through these numbers up here.
Yep, I'll kind of jog through them real quick. So we've got purchase price, obviously, of $810. We appraised out at the contract price. Loan amount was 95% of that purchase price. And then we had some additional funds to buy down the rate. And then I think you negotiated pretty nicely, Jeff. Excellent work, as
you.
always. Within that price, some seller credits that we utilized towards the closing costs, buying down the interest rate, and making this optimal for Matt's purchase. So pretty straightforward house hack on a 4-unit
Yeah.
property.
So
nothing dramatic there.
altogether, he was about what, $36,000
Yep.
closing
For everything.
altogether.
Yeah, that's kind of his all in,
Wow.
which
That's-
is pretty stellar on an 810.
Yeah, so it's
Four-unit.
$810,000 Fourplex, all in for $36,000 and change.
Yep.
Yeah, sounds like great property right
Yeah,
there. Great
the
numbers.
whole
Very
point
first
of a
one.
house hack. Yeah.
And then, what's the strategy once you close on it? You're living in one unit, and then
Yes. Yeah, so I already had 4 out of 4 units were occupied, but one was month-to-month lease. So he moved into, and that was the worst unit. So it's actually kind of a perfect setup. So the 3 out of 4 units were already moderately renovated, kind of more rent ready, and that one unit that he was going to move into needed the most work. So it's like almost perfect experience where he doesn't have to deal with 4 units that need to be renovated, just 1.
So he'll do a
He'll do the work.
live-in flip while he's there?
Yeah, live in, flip, house hack, and get a roommate.
I think he's going to have his dad come out and help him do a little few renovations.
And then his brother lives here, so it's kind of nice that he has a family close by and his dad's handy. So he'll get that renovated, live in it a year, learn how to be a property manager, on-site property manager, learn how to deal with contractors, doing the work himself. He'll get some great education that first year.
Yeah.
Without going all in on like a true fixer-upper multifamily.
Yeah, just light stuff.
Yeah.
Yeah. The other little challenge we had with that one too, remember, was the occupancy within 60 days.
Yes.
And so we needed to work with the listing agent to make sure we had that 1 unit available to him so he could occupy it within 60 days.
Yeah.
So, and that worked out well.
Yeah, nobody able to get that.
Yeah, everybody got on the
I think
same
it's hard
page.
to get the signature from that tenant or something like that.
Yeah, you had to do a little bit of a cash for keys, right?
Yes. Yeah.
A little.
Oh, yeah. So it wasn't month.
Grease the wheels.
It was like 1 month. It was like 90
It was
days.
ending. Yeah, it was ending, but not quite
Yeah.
at the 60-day requirement.
Yeah.
So, but we worked through that challenge and got everybody to be happy.
Yep.
No, great job.
Yeah.
All right, so let's talk about some tax items that landlords need to keep in mind.
Yeah, I would say the big ones on here. This is where people like look at their mortgage payment and what is it, Troy? The first 5 years is 90% interest.
Yeah,
But
vast
then
majority.
you see it, it's like, oh my God, I paid on my $3,000 mortgage payment, $2,500 is mortgage interest. And that you're kind of like, that's a lot of money to spend for interest. But what people don't realize, 1 year later, now you can write off on this example we gave, the Fourplex, 75% of all that interest, because 75% is an investment property and 25% is the primary residence for this that Fourplex example. So you get it back on your taxes the following year. So it's not like and your tenants are paying for your mortgage. So it's not like you're paying it, tenants are paying it, and you get the benefit the following year. Say in depreciation, that's my favorite thing in real estate investing. So on a residential property, it's you don't depreciate land because land doesn't appreciate. You depreciate the building itself.
Yep.
27.5 years. I don't know how they came up with that number. That's just some IRS
Random.
rule.
Yeah.
But you can divide the value of the building by 27.5 years, and you get this magical thing called depreciation that you can write off on your taxes and over 27.5 years. And then the great thing is lenders add it back. So
We don't count that against you.
yeah, so you show a loss potentially in your taxes with depreciation, and then the lenders add it back. So it's a huge benefit for real estate investors. And people say, well, what if I don't take it on my taxes? Technically, the IRS, doesn't say, oh, you didn't take it, so we'll just give you some type of credit. They actually say, well, you should have taken it. So majority of everyone should take it because it is a great benefit, and lenders do not punish you for it.
Right.
Repairs, I mean, this is kind of more of a generic. So there's a thing called repairs or capital improvements. We'll get into that later, but repairs are more like you send a handyman to fix a door jam, the sink's leaking, you send a plumber to fix that. All that stuff you do throughout the whole year, as long as it's not, it's the units that are not the ones you live in, then you can write off that on your taxes the following year. Personal property, I think that depends on what it is. If you have like an Airbnb, so personal properties like furniture, stuff like that. So that one's more gray.
But we did talk about the rent by room,
Yeah.
where if you have that common area and you
Correct.
put some furniture in that common area, that I think Donovan agreed that could be some
It's a
deductions
business
there.
expense right there.
Yeah.
So like under
So if you
Matt's
do the
example,
couch,
if he furnishes it all over the place,
coffee table,
and then he rents a room, he could potentially write off all that furniture and kitchen stuff. Yeah.
Yep.
Pass-through tax deduction. That's like probably a little more in depth for this conversation.
Right.
Travel mileage. So if you're traveling to and from the property or going to Home Depot and all that.
That's a big one. Donovan said that
one's
people need to keep track of. Use an app.
Yeah. There's
Have
like
something that keeps track of it because those trips are deductible.
Yeah,
And
exactly.
we actually, from an underwriting standpoint, will account for that too.
Yep.
And that can help you. Doesn't hurt you.
and employee and independent contractors. So obviously when hiring handyman, and most likely most people don't have employees just yet, but that also can be deductions. Insurance, that's, when you have homeowners or landlords insurance, that's a write-off. those are the major deductions. And then legal professional services, what is that? So if you hire an attorney for an eviction, that would be a write-off. Or if you hire a tax person, that's a write-off too, because your tax prep counts as well. So you see in the utilities and taxes, so tax is more property tax. And utilities, so for rent by room example, if you're renting a room out and you're paying the electric bill, the water bill, the sewer, you could write off a percent of that. We'll get into more of that in future slides. But you see, this is just like a few items, and there's more in this, but this is kind of showing like it's easy to, what it really shows is easy to show a loss. Your first year, especially when you're starting out and getting that property stabilized, you have no problem showing a loss on your tax return. But in reality, you can actually make positive cash flow. And that's the goal, to get positive cash flow in reality and then show a loss in your taxes and then make Troy happy by not writing off too much. And when they add back depreciation and other stuff, that they call it a net positive. And we'll get into that later.
And that's really like the key message takeaway from the podcast here is just get your eye on taxes, start researching it, start talking to ChatGPT, start talking to your CPA and learn how to optimize all this stuff, because it is so important. And you learn those skills, where you're at now, because they just become more and more important with the more income you make and the wealthier you get. So, just some key things that house hackers need to keep in mind. I think the first one is obviously just good records, right? I mean, we talk about all the time, keep good records. And the nice thing is now there's so many different apps out there that can automate, that either link up to your bank account and credit card for pretty automatic expense tracking, or the apps for mileage tracking. And then, depending on the strategies that you're utilizing, make sure you start really researching how those work. Hey, the room by room write off, or I'm living in 1 unit out of a 4 unit, so I can write off 75% of the depreciation or whatever it is. Like, really dive into the strategies, the tax based on the strategy you're doing as an investor, and then become an expert on there, and then learn those nuances and keep records on there. And then, of course, you do that, just start understanding, okay, how this expense. First, what is it? And I did this years ago. Okay, how can I write off this expense, or can I write it off? Because sometimes it's a year one, or write off this year. Sometimes it's a capital expense, which takes 5 or 7 years to write off. Sometimes it's depreciation, which is a phantom loss. So there's all these nuances on there. Just start going through your expenses and then start Googling it, talking to your CPA, understanding how that can potentially impact what we're talking about here.
And I would say on top of that is once a month, right? There's so many apps. I know some people struggle with keeping organized or keeping track of accounting, but there's a lot of ways you can make it easy on yourself. And how do you make it easier? It's pretty simple. You have one checking account for all the properties. So whether you have one property or 10 properties, you have one checking account and one credit card. And you can get the travel rewards card, the cashback card, doesn't really matter, just one credit card, one operating account, and then maybe one more account for security deposits. So that's it. You don't need to have 10 separate checking accounts, 10 credit cards. And just imagine, how can I make this easier to keep track of things? That's how you make it easy. So if you start off making it easier on yourself, your future self would be very thankful when you have 5 properties. Instead of trying to say one account for every single property, it's going to make your head spin and way too many accounts to deal with. Because once you get to a point where you're doing it once a month and being consistent, you could easily categorize all these expenses and know exactly what goes to what. Because if you look back 1 month, it's easy to know, like, okay, this is property 123 Main Street, or this was 456 Main Street. You'll know exactly what it applies to. And then 1 year later, when you hand all the documentation to your tax person, now you'll get the maximum benefit because you are organized once a month and spend those hour or two going through your checking account and your credit card account. And that's really what I think a big takeaway of this podcast is, just being organized. And it doesn't have to be complex. And I know some people are terrible with numbers or keeping track of things, but there are, like Chris said, there's a lot of apps. And there's ways to make it much easier, or apps that kind of, you categorize certain expenses and then it remembers that for the future months. So you just have to kind of go through to confirm it was for that property or that category. And then it's a lot easier.
Yeah. All right. I think, Jeff, this is just an example of one of your spreadsheets, right?
Yes.
That you probably keep here. And I said, this is just a spreadsheet version. You can use apps, or I think Jeff, myself, we are very spreadsheet biased as well.
I like spreadsheets.
But just a good example, and I mean, it's a great one. You can build your own relatively easily. There's also, I think, like 3 kajillion templates on the internet too for it, I would say as well. Like just a basic way to keep track of your expenses, and you start seeing how things are to optimize it. And also, your CPA will like you a lot more when kind of do tax returns. You can build out summary statements like this as well. Now, we're showing some screenshots here. If you're not watching the video, just spreadsheet screenshots. Hard to say 3 times fast there. Into what these record-keeping items look like. And then Schedule E. I know we're not CPA here. What is a Schedule E, Troy? Because you deal with these.
Yep, look at these all the time. And this is where you bring forward your property information onto your tax return. So each slot there, you got A, B, and C. If you have 3, Jeff has like 4 Schedule E's, I think you have now, Jeff, with all your property. Each property's listed out individually, and then you have all your different various expenses associated with that property. So that was kind of the key with those spreadsheets that we just glanced through and being organized, is those correlate nicely over to the Schedule E. So when you're providing the information to your CPA, it's like, here's all my advertising expenses for this property. It's all in that slot. So it just all funnels down nicely, and then it's like, okay, each property plays out. But yeah, that's what we look at is we take each of these properties, do an analysis. I sent you a little worksheet one time, Jeff. There was something you geeked out on a little bit, and how underwriting dissects the property. We take a kind of a conservative look, but like you said, if there's depreciation in there, we add that back in. We don't count that against you. But we do have our formula for looking at this. So again, having a CPA that knows their stuff and how to take those deductions accurately and correctly with our friends at the IRS is paramount.
And the biggest thing too with that is it's all it really is. It might look intimidating for someone that, first time they're seeing it. It's just rental income and expenses, and then you just like Troy said, ABC is for each property, and then it's a roll up of the whole year. So it's not like it's anything more than simple, basic accounting from like 4th grade math.
It really is. It's addition and subtraction.
Yeah, that's really all it is. So it's really not complex math. You don't have to be a tax person to understand this form. It's just a form that's important to know when you do have rentals. You're going to be using this form, and this is what every lender that when you're qualifying for your next one or your current one, they're going to be looking at this to understand how each property is a separate business, and they want to make sure there's basically self-sustaining businesses. So that's how you qualify for more than one property. It's not anything more complex than that.
Yeah, it does, and it doesn't matter what your employment situation is, whether you're self-employed or W-2. If you have investment properties or property in your portfolio, we're going to want to look at your Schedule E. Yeah, and it's simple, like you said, simple math. They're each little individual businesses, and so you have gross revenue and expenses. Yeah.
All right, so this is a common question here that comes up with house hackers, and obviously talk to your CPA about this because you'll have different opinions, but how to allocate between rental or business expense and then personal expense while you're living at the property and house hacking it. We've already talked about this, but the 2 methods I've seen people do is just a unit or square footage. Hey, I live in the Fourplex, and I live in 1 unit. The other 3 units are rented out, so I write off 75% of my expenses here towards the business. I've seen some people room by room do square footage. Hey, this is a 2,000 square foot house. 500 square feet is my personal bedroom. The rest is rental or common area, so that's a business. So therefore, 75% is a write-off. Now, again, the thing on here is make sure you talk to your CPA, because I've had different CPAs say what you can and can't write off differently.
They do have some different opinions.
Yeah, they have different opinions on it. Like, for example, the rent by room house hackers that live in a single family house, live in 1 room, rent out 5 rooms. Some CPAs will say, yeah, you can write off, everything but your 1 room, like the square footage method that you see on there. And some will say, well, yeah, you could do all that, but you have to also, you can't write off the common areas and you have to include the common area square footage plus the kitchen square footage. And some will say, no, you can actually, like, so they different opinions. We're not CPAs, so talk to your accounting professional and you'll get the answer.
Yeah. And then let's talk about additional write-offs. How do you categorize this, and how do you handle this, Jeff?
Yeah, so the bigger ticket items, right? Water heaters, furnaces, the ones that technically, if you replace it, it really repair versus replace. So when you have repair a water heater, replace a water heater. Water heaters last 10 to 12 years. And usually it's called a capital expense for those like major appliances. Like a water heater, furnace, AC unit. So you can't just take that, $2,000 for a water heater replacement or $5,000 for a furnace replacement. You're going to have to depreciate those over 5, 7, 10 years. So that's the difference between those versus if you send a handyman to repair the water heater and they fix it for $300, that will be a write-off to for that tax year. So that's the big differences. And then some people write off, it can be a gray area sometimes. And I don't want to get too much in the weeds there, but some people do just write it off even if they replace it. But usually the general consensus is when you have a capital expense, that's more like the replacing the whole appliance. That's not repairing it. So then you're going to have to depreciate that over that shorter amount, not 27.5 years, but it'll be what the depreciation schedule says on the tax.
Which is usually like 5, 7,
7
10.
years. Yeah. So it's not like you don't get a benefit. You just don't get to write off $5,000 for that furnace replacement in that tax year. It'll just be spread out over 5 years or so. Repairs. So repairs is pretty straightforward. That's just like, you send the handyman to repair your sink that's leaking. That's a write-off for that year. Your deck, needs to be new support beams to help support it. That's a repair. Your cabinet doors a door broke off, so you got to replace that. Like that's a repair. Little stuff like that. That's more like immediate. Like it has to be fixed to have to meet like health and safety stuff. Like that could be definitely repairs that could be written off. Home warranties. Actually I haven't. That one's kind of also might be talked to a tax professional because that could be. Some might say you can write that off because usually they're about 1 year for home warranties, and then ones that maybe go longer, maybe you have to potentially spread it out.
Never thought about having to amortize that.
Yeah, amortize the home warranty. Closing cost, again, I'll talk to your tax professional, but usually I've seen them write off the closing cost on their tax.
Yeah, there's a fair amount of stuff in there that they can write off, but they know specifically what's allowed. We get you a copy of the final closing disclosure, which you want to keep for your records. Yep.
And then receipts, there's so many apps now, you can just take a screenshot. Like if you don't want to carry around a little thing that holds all the receipts, I get it, it's a bunch of paper. You just take a screenshot on your phone, save it in a folder. You could there's different QuickBooks apps, there's different apps out there. You could just save all your receipts as much as you can. And then if you have I paid a handyman on Zelle or something, $100, then just categorize it, right? It's in the memo line when you type in the description, just say okay, 123 Main Street, sink repair. That's it. And then now if you ever got audited or if that chance happened, just do it right away. So you don't have to figure out what was that $100 thing I sent for that handyman. I have no idea. Just categorize it correctly in the front end and then save that documentation. So when that time comes, if you ever get audited, you have everything ready to go and everything's saved over. So there's no hey, can you pull these 5 receipts? You're like, sure, I got them right here. And then it's no questions there. And then the mileage, and that's another one that people don't really think about, is if it's easier to do it while you're doing it. So don't try to say, okay, I think I drove 2,000 miles last year from my property, going back and forth from Home Depot.
Not a good
that
idea.
doesn't work.
Not a good idea.
So just track it. You have a logbook. There's apps out there as well. So the great thing about today is you don't have to do as much writing. You don't have to write anything anymore. You can your phone is your magical device that can track it all for you. And use that to your benefit. And
if you bought an app, you can write that off.
Yeah, actually, I count too. Yeah, all that stuff is that's what's cool about it. It's like a little small business. So you have all these great, amazing write-offs.
Yeah. And then, this is obviously a very important member on your team is a CPA. Now, there's very few CPAs out there that understand real estate. So we'll go and tell you that out there. That is one of the probably most persistent referral requests we get. And a lot of times the CPA will take clients, they get full, and they're no longer taking clients. Like my CPA has not been taking clients for like 5 or 6 years. He's like, nope, I'm good. And it's a small business, him and I think 2 or 3 partners. And they're happy with they're taking no more clients. And I know many CPAs who are like that. So understand finding a CPA that's taking clients and also knowledgeable in real estate will take some work on your part. Pro tip, don't do it in February, March, and April. Do it after tax season is over. Don't be calling around in March and expect to find a CPA who's going to take you on because they probably won't. File your extension and find a CPA that can help you out. But definitely ask them if they have experience, with working with real estate investors. If they've done house hacking, or if you're doing other investing, other investment strategies in real estate, ask them specifically if they know co-living or room by room, if they know house hacking, if they know rental properties, because a CPA understands real estate is so much more valuable than I'll just say standard CPA.
And I've witnessed tax returns prepared by somebody that didn't know.
Yeah.
And they've made a mess.
Yes.
And I've actually had a client that was doing some work himself. He did his own tax return, Jeff,
geez.
with 3 properties he owned.
Yeah.
And awesome that he owned several properties, but he absolutely butchered his tax return.
Yeah,
to where he
up.
couldn't even qualify to buy the next property.
Yeah.
So he actually had to file an amendment, and then we had to get that amended. He went to a CPA to get it filed, and then we had to wait for that to transcript into the IRS to where we could get him his loan. So massive delay, massive issue. So to your point, Chris, hire a professional that knows what they're doing.
Yes.
Pro tip.
Yes.
So, with that said, we really covered like some key points here on, tax consideration, some tax strategy. Hopefully that gives you enough out there to start keeping a better record keeping, getting you focused on learning more about it, or finding a CPA that can help you go from doing it yourself to, scaling up. But if you have any questions in general for, finding your house hack, reach out to us, right? Troy is our go-to for lending. He knows this stuff. He's really good at helping people understand where they're at, what they can buy. I don't know, 3 or 4 times a year, Troy will take a hot potato from another deal, another lender where, hey, they're set to close. And then all of a sudden, 3 days before, for the reason they can't close, we call Troy with a fire drill. And most of the time, Troy's able to solve that problem, which is grateful. We don't like to be last minute, but it gets the job done. So absolutely big recommendation to talk to Troy if you need lending help. Yep. And of course, talk with Jeff White here if you want to go out there and find your first or your next house hack, because he is, a top producing agent and also house hacks himself.
Yep.
We talk about finding a CPA that knows real estate. We'll work with lenders and brokers that know real estate as well and do the strategies. So if you guys also need any CPA recommendations, reach out to us. Like I said, they are hard to come by, but we usually have 1 or 2 that hopefully stick in some clients. Reach out to us, and we will make an introduction if we can. Troy, Jeff, another fantastic podcast. Thank you guys so much.
Thank you.
Thanks, Chris.
All right, everyone. We'll see you next podcast, or join us for the next month meetup. Talk to you soon. Bye-bye.